Testing, testing. I have a few announcements before we get into Jonathan, our program. One of them is late last month in July, we have a new listing agreement, residential listing agreement. And if you've inputted a new listing, there's a new status, and it's a coming soon status that we've been talking about, and Danny's been involved in this now, I think probably for 2 years, but it's just came to fruition now that instead of doing active, agents can do coming soon. So what this does is it does away with all the other stuff that we used to do where you had to submit your listing and exclusions to the Association of Realtors. And with this new listing form, everyone now has the opportunity to do coming soon. And what's neat about the new form is when you input that listing, there's actually on the CRMLS, on that input form, when you click on the status as active, it gives you that coming soon status, and it gives you the link to this video. So it's only a 2-minute video. So let's play this now and see so that everybody has a chance to see it. And if you have
Understanding coming soon in CRMLS. In response to the NAR-mandated Clear Cooperation Policy, which takes effect on May 1, 2020, CRMLS is introducing a new status called Coming Soon to its MLS systems. Our users ask for a way to take time to get properties ready for the market and to create entry and excitement for their upcoming listings. So we've prepared a brief introduction to this status, how it works, and how it differs from other statuses. How does Coming Soon work? Coming Soon allows listing agents to take up to 21 days to stage the property, take photos, prepare it for showings, and so on. What are the similarities between Coming Soon and active? There are a few key similarities and differences between Coming Soon and active listings. Let's go over similarities first. Marketing is allowed in both statuses, so long as Coming Soon listings are clearly marked as Coming Soon. Both Coming Soon and active listings are fully displayed to other professional users of MLS systems. The listing agent offers a commission on both Coming Soon and active listings. What are the unique traits of Coming Soon? Now for the unique traits of Coming Soon. While all CRMLS users can see listings in the Coming Soon status in the MLS systems, Coming Soon listings will not go out from the MLS to portals like Zillow, Trulia, and Realtor.com. Neither will they go out to CRMLS's network of IDX broker and agent websites. CRMLS will, however, distribute Coming Soon listings to VOWs or virtual office websites. For more information on virtual office websites, view the flyer linked in this video's description. Showings are not permitted in Coming Soon. There are no showings under Coming Soon because showings are contrary to the status's stated purpose, which is to prepare the property for full marketing. In other words, the presumption is that the property is not ready for showings, so a Coming Soon period is allowed until it is. If the property is ready or able to be shown, it should be an active status. Because of these limitations, days on market do not count in Coming Soon. This is because Coming Soon listings, unlike active listings, are not yet ready for a full marketing push. That's all there is to it. If you have further questions on Coming Soon or the Clear Cooperation Policy, feel free to visit crmls.org. Thank you for watching.
All right, so if you got comments, again, raise your hand. I'll give you my 2 cents on this. And as you know, Danny and I have never been fans of the Coming Soon. Me being old school, I was always taught that whenever you have a listing, you have to put it out and have to cooperate with everyone. Now it appears that even though the intentions are good, I see a lot of agents showing properties during this Coming Soon status. And as Danny just updated us, the other portals like Zillow and Realtor.com, the CRMLS actually, Board of Directors passed to have that disseminated. So within the next couple of weeks, everybody will know about a coming soon. Even today, when you have a coming soon listing and you have let's say a database of buyers that are updated with their auto emails, they will get notice of those coming soon, even though technically, and I say that word technically because I don't think everybody is going to abide by that rule, they are not to be shown. So what we're seeing, what Danny and I, what we concluded here is after a few months, we're going to see all these listings have 1 or 2 days market time, when in fact they had as much as 21 days marketing time, but they're going to be able to post them right when the offers are presented and get them sold with just a few days. We're also, we can foresee when sites will be advertising, click here to see off-market listings, where we can legally advertise these off-market properties that are coming soon. Even though all realtors have access to it, you can see how the public is going to be misled, and more importantly, I think sellers can be taken advantage of if the property is actually sold during this coming soon and not exposed, not shown to the full market. So, and that's another reason why TRG, we don't do those dual agency listings or transactions with just one agent, because I can see how sellers can be taken advantage of with this new status. But it looks like this is with us for now, and it'll probably be months, if not years, before we get to any other changes. So that's the latest. Any comments out there? I don't see any. Danny, yell if you see anybody's hand goes up or any questions out there. Okay, so I do have some announcements. Again, both CAR and NAR has daily reports on their websites. Many of these we forwarded to you as we receive them, and it lists websites that have more restrictions. For example, Los Angeles in the pandemic, as far as the requirements that the individual cities have made. For last month, we actually had 14 closings. We paid out $157,000 in commission, with sales of just under $10 million of our TRG agents. We're still below our norm, even though I'm getting reports that statistically the numbers for California will equal or exceed the sales from 2019. And I'm sure that's all driven by these interest rates, as we'll hear from Jonathan. We actually had 5 agents join TRG this last month, and as I mentioned, Elva had 2 closings, Amanda had 3 the previous month. Our office hours we're still at Monday through Friday, 9 to 3. Many days that we're in here later, but if you need to stop by, plan on doing that between 9 to 3, and we're closed Saturday and Sunday. Every Thursday, we're doing our lunch and learns via Zoom. Tomorrow at noon, we will have Danny on digital signatures. And as you know, we've been recording our lunch and learns for this last month or two. And so after each of these meetings, we send out an email with a link to the recorded lunch and learn. And at that link, you can also pick up any of the past recorded meetings that we've done. So it's a good way to catch up in case you missed one of our meetings. I have a nice thank you note that came in to Lauren and me about our agent Mike Rim, but I don't see him on our roster here, so I think I'm going to save that for next month so I can embarrass him by reading that thank you. It's a very nice letter. All right, so before we get, last thing here, before we get to Jonathan, I want to just kind of go through some of the COVID stuff. We actually have, I have about an hour on this on one of the lunch and learns, but just to reiterate what's necessary is that when you show properties, remember that you have to use that PEAD, that PEAD-V for visitors. And some listing agents also require you to send over that pre-approval along with that PEAD-V before they will make an appointment to show. We mark that on the new listing that Danny and I just took. That's one of the new items in that new residential listing form, where that seller is requiring that in order to open up his house for the public to come in. So it's not out of line for a listing agent to require that pre-approval or that pre-qualification and the PEAD-V prior to setting an appointment to see the property. So again, buyers, all you need is that PEAD-V to have them sign that. When you take a listing, the seller signs the PEAD-S for seller, and attached to that is a copy of the best practices, that BPPP form. And you also know that you'll need to post the rules of entry, that PRE. It's actually two forms. One's a sign, and one actually lists the different rules, basically stating that you are practicing social distancing, that you're wearing a mask, and that you're not sick. Listing agents, according to these forms, should make available at the property hand sanitizers, sanitizing wipes, and face coverings. Those are required. It's required to wash your hands immediately upon entering any of the listings. And this is the listing agent's responsibility according to these forms, directly before and after every showing. It is the listings agent's responsibility to see that the property was disinfected. And this includes all doorknobs, railings, lock boxes, counters, light switches, sinks, and toilets. So that is, again, the listing agent's responsibility. We are not to hand out flyers. We are to clean any of the keys and lock boxes and provide a trash receptacle for the disposal of any masks or gloves, etc., that the visitor may have. It is the listing agent's responsibility to ensure that the property is thoroughly clean, disinfected, and that visitors abide by social distancing rules. Okay, so as a review, every visitor signs the PEAD-V, and the seller signs the PEAD-S for all new listings. All right, so anybody want to work out there? For those that are working, as you know, I keep saying this is unbelievable times, interest rates at that 3%. Many of our agents have never been busier. CAR is doing an excellent job of keeping us informed on COVID-19. And sometimes we get daily updates. Every Friday, they have a meeting of their directors that is published. So if you need any information, all of that is on the CAR website. Focus on getting listings. The supply will be bought up, and we're seeing that already, that there's a shortage of inventory on the market. My 3 steps to success today, and then we'll get over to Jonathan. 1, if you already have a farm or a sphere of influence, please contact every one of them, educate them on the market, let them know that you are working through this. They will want to support you. Number 2, if you're new, start your sphere of influence with people that you already know. Call them, educate them on the current market conditions at low interest rates. There's still some inventory out there, very little competition. And did I say historic low rates? This is incredible, especially for us veterans, to hear about this 3%. And lastly, number 3, If you're not working or can't work, prep yourself for when you do come back to work. Work on your goals, plan your work, improve yourself with education, renew your license, or get your broker's license. We're providing those courses free for our TRG agents. Okay, Jonathan, you are on. Good morning.
Good morning, Durf, and good morning, everybody. Sorry I don't have a camera on. It's not working. Wait till after Thanksgiving. I'm going to be buying my new computer then. That way I get half off.
Well, you can always watch the surf behind me. That's fine.
I love it. Reminds me of Hawaii. It is Hawaii. Anyway, guys, let me start off by saying how the rates are doing today. Check this out. Hang on to your seats because 15-year fix is going at 2.25% reserve points, and the 30-year fix is going at 2.875%. That is for FICO scores of about at least 740 and above.
Okay, Jonathan, I got to interrupt you. Did you say 2.25 for 15 years and 2.8 for 30 year?
You got it, and that's for a loan amount of 510 and below, 510,000 and below. Anything?
Unbelievable. And then if you get a jumbo, what is it for, like up to 700,000-800,000?
You're looking at about the 3.125%.
Wow, that's just incredible.
It's incredible. I locked. It was lucky. The customer of mine locked in at a 2.99% on the condo, and she was, like $5,000 above the conforming loan limit, which is 510,000. So it's one of those days. When rates dip and you're in the right position, you get a great rate. But regardless, you get a 3.5. It's still historically low. Now, what I'd like to do is I'd like to share with you my screen because I'd like to show you some new programs that are out there. And you guys feel free to, ask me any questions anytime during this presentation. Okay. So Danny, could you, is there any way that I could share my screen in here?
If you could just click on the green share on the bottom.
Okay. Hold on one second. Let me go there. Oh, 1 second.
And just select the window that you want.
There you go. Screen share. Okay. Can you see it?
Yep, you're all set.
All right, great. Let's see now. Let me just go to slideshow. There you go. All right. This is something you may not have heard before, Fannie Mae Family Opportunity Mortgage. Wondering what that is? It's a loan by Fannie Mae. It allows a child to purchase a home for their aging parents, and at the same time, it doesn't have to comply with the rates for investment or second homes. They will give you the rate as a primary residence. So you could avail of those very low rates. The child does not have to own or occupy the property, just the parent. And so this is one way to save because a lot of aging parents right now are being put in, assisted living. And by purchasing a home, an affordable home with maybe a caregiver, would even be less in terms of monthly payment rather than having to, put that aging parent in an affordable home or, assisted living rather. Okay. So again, they could avail of the historically low rates. Now, program number 2, VOE only programs. I've discussed this a few times before in the meetings, but this comes very handy when you have a borrower that, let's say, is a wage earner and all of a sudden became a 1099 employee or an independent contractor, but still working for that same company. Anytime you switch from being a wage earner to 1099 or an independent contractor, did you know that you have to, have at least 2 years as an independent contractor again for them to count that income? So being that, let's say, if they switch into that or they're that in position, or maybe they might be a mechanic receiving a basic pay and then cash income, in addition to that, or those that are receiving basic plus commissions, but it's not steady or it hasn't been seasoned for a year or two. This is a good program to have because, all they need is the verification of employment with the employer. And they will be, this is a different program, but they will have this available for them. Now, the minimum down payment for this program is 10%. You could get a 100% gift. Good thing about gift in this program also is that the gift donor does not have to show, bank statements as proof of funds for gift. All the donor has to do is wire the funds to escrow and provide that wire receipt. And that's it. Just a gift letter and a wiring receipt, you're done. The catch here is that the rates are in the mid to high fours, especially at this time of historically low rates. But that being the case, still not a bad rate to avail of if you can't, if you can't qualify under the Freddie Mac, Fannie Mae, or FHA programs. Now, this is for primary residents only. Okay, let me know if I'm going a bit too fast or if I'm going at a good speed. Okay, Danny? Okay, gift equity purchase. You guys, maybe some of you have done this. And the way this works is if a parent is selling the house to a child or child to a parent, as long as you're related. So here's the relationship: parents, children, children to parents, uncles, aunts to nephews, nieces, vice versa, sibling to sibling. You could avail of an FHA or conventional loan on this program. And so when, let's say you're making that sale, the equity gained on that sale is actually going to be given as a gift to, the purchasing relative for the down payment and closing costs. So guess what? That relative of yours won't have to come in with anything other than just qualifying for the loan. All right. Home Possible. Some of you may have heard of this, others not maybe. Home Possible is a great first-time home buyer program. And, here are the matrix of it, minimum of 3% down. And if for 2 and 4 units it's 5% down, minimum score of 640. It's only limited to conforming loan limits. And conforming loan limits is for a single family or condo is maxed out at $510,400. It's a 30-year fixed term only, owner occupied, first time buyer. That buyer will have to get a online class and get a certificate that she's completed or he's completed the online class. And the income restrictions apply most of the areas. So that's the only catch. And with California properties, most of the time, income restrictions do not qualify for the type of prices. However, I'm seeing a lot of these, this program being applied on my San Bernardino, Riverside, Victorville properties. So, they're availing of that over in that side of town, okay? Conventional, we all know what conventional is. It's a Fannie Mae, Freddie Mac program. But just to rehash, if somebody's refinancing and needs somebody to come in to help qualify for that refinance, there's no title or seasoning to any borrowers added on the refinancing. Post spotlight, okay. W-2 forms only are okay, which means they may not require tax returns unless you have a Schedule C or K1 or your corporation or self-employed. In terms of bankruptcy, they only require, let's see, a discharge, 2 years extenuating service. That means, with a BK on conventional loans, there is a 4-year seasoning from date of discharge, okay? But if you have an extenuating circumstance, like hospitalization or something that was out of your control that happened to you, they could cut that down to 2 years as long as it's that extenuating circumstance is documented. Foreclosures, 7 years, unless you had again an extenuating circumstance, 3 years from the date of that foreclosure sale, then you could qualify for another mortgage. Deed in lieu, as you can see here, foreclosures 4 years from completion date. Again, 2 years with extenuating circumstances. 203K rehab loan. This is a great loan to have. Danny, as a matter of fact, availed of this loan when he was purchasing a property because, there were some things he wanted to fix up. Now, this is great for properties that are kind of distressed, where you wanted to update at least the kitchen. Here's a good example of before and after. What this loan allows you to do, it's still an FHA loan with a minimum down of 3.5%. What it allows you to do, it allows the homeowner to purchase the property, make improvements while living in there, or not living in there, they'll give you 60 days to occupy the property. And you could make the necessary upgrades you want to make. So FHA will allow you 3.5% on top of that, lend you up to $35,000 for your rehab expense. Okay, and here are the list of repairs that are allowed for a streamlined rehab loan. You know, new counters, cabinets, patching holes, replacing installation of HVAC, lead-based paint abatement, purchase installation of appliances, and maybe other minor details around the house, as long as you don't exceed $35,000. Now, there's another 203K loan, which is called a 203K regular loan, which will give you up to about $100,000 to repair the property or more, as long as it doesn't exceed 116% loan to value. It will allow you to go above, 110, right? What am I talking about? It won't allow you to go above 110 at 110% loan to value with the regular loan. Also with this streamline, you know, you could go up to 110% loan to value. Okay, it's just that the regular 203K loan, you know, does require more inspections, a HUD inspector to go in there before doing the work or before getting approved, because he'll have to submit a feasibility study and in addition to the appraisal. All right, any questions so far? I don't see any. All right, moving on. FHA loan, my favorite, 3.5% down. You know, one thing good about FHA is it does allow the borrower to exceed the back-end ratio of 50%, which is, you know, capped by conventional loans. You could go up to debt to income ratio on the back end, as long as your front-end ratio, the front-end ratio is future housing payment divided by income, does not exceed 46%, okay? And FHA will go up to 55. We're still taking in a minimum credit score of 580 FICO score. I must warn you though, if it's a purchase and you get a buyer coming in at that FICO score, you gotta have 60 days on escrow, because you know the banks are inundated with files right now. And underwriting is gonna slow down a bit, only because half the staff are working from home and there are additional protocols added on to the process. And you're gonna have at least 2 or 3 times the amount of re-verification of employment, you know, before, during, and then right before funding. You know, they'll verify by phone. And that's for all loans, not just FHA. Now going back to FHA, single family to 4 units, that's great. It allows you to bring in as little as 3.5% down. The only thing, you know, about 3 and 4 units, especially you listing agents out there, you know, when you have an offer coming in, FHA, you got to make sure that the gross debt service credit is what they call it, you know, for the 4 units will meet the requirement of the property. Meaning what happens is the gross income of all 4 units times 75%, that would be the net, must equal the PITI. If it exceeds the PITI, then you don't have a qualified property. And I've seen this happen a couple of times before with some units over in Long Beach. Well, what did we do? One of those units, thankfully enough, the co-signer was making strong enough income and had some money in the bank. We switched that loan from FHA to a 10% down home possible program. Remember that program I previously talked about? We switched it to that program. She's a first-time home buyer, and we were able to get that thing done. Okay. FHA, no credit required, at least with one borrower. But if a borrower's coming in with no credit, 0, like a ghost, they need to have a co-signer with at least 2 credit scores to qualify. Back in the day, they didn't need that. They'll just go with, you know, alternative credit sourcing like credit rating letters from utility companies, insurance, your phone, and all that. But today, if you got no credit, you have to have at least a co-signer with at least 2 credits. No reserves needed, 100% gift. The difference between FHA and conventional in terms of the gift is that while conventional only requires a gift letter and a wire receipt as proof of funds, FHA does require the latest bank statement to show proof of funds from the gift donor. And then, in addition to the gift letter. And then once the donor clicks over some funds or wires funds or writes a check to the recipient, they will be required to again get a printout from their bank statement showing proof of liquidated funds and updated balance on their statement. So it's a little bit more intrusive as people might, as the most gift donors may feel about it, but unfortunately that is the case to meet the requirement. Now, FHA could go all the way down to 550 FICO score. I haven't seen this happen yet, but there are a few that may qualify as long as they put 10% down and have 6 months reserves in their bank after closing. And of course, the debt to income ratio is strictly capped at 31/43. No exceptions on that. You only need a 2-year seasoning from discharge for the BK and 3 years for foreclosures. Not bad. It's really a great loan for those that have limited funds or challenges with their credit scores. And it's a good starter loan. Eventually you'd like to refinance out of FHA anyway, once you've enjoyed the growth of equity in that and qualify for a
Hey, Jonathan, back on that 6%, does that include commission credits?
6% credit by the seller? Where are you seeing it? I'm
Yeah,
sorry.
so can you also do a commission credit?
Oh yeah, absolutely. You could to the borrower. Yes. Okay. Just to give you an example of what
And Jonathan, if I can interrupt you also, can you talk a little bit about, you mentioned it here on delays if you have a lower FICO score, because I'm hearing from some agents that lenders are closing escrows in less than 30 days, and then others are taking 60 days. So what's going on?
Okay, well, the difference there is the type of bank that you submit to. For instance, if with a great file and good credit score, then we have a source wherein you could actually close within 30 days. Maybe a little bit less if in a perfect world, if everybody is good to go with that. However, if the borrower is credit challenged, a lot of these banks that are closing really fast, that's just because maybe they might not be inundated with files. What happened was after COVID came, a lot of banks went back on their usual lender overlay, wherein they're increasing the minimum credit, score for, let's say, FHA or conventional. They want at least 640 and above. If you have a client that maybe goes below 640, then there are only limited funding sources for that. And so everybody is going to these handful of sources, thereby inundating their production. And that's why their flow is going to be so much slower than those that may not be inundated with files. So it really depends again on the production flow of the bank. There are a couple of banks that are at least very good in terms of turning their turnaround times, and I use both banks. One is Quicken and the other one's UWM. There might be one or two maybe that I don't know of yet, but it totally depends on these banks and then how the production flow is. And also the file. The file has a lot to do with it. If the file is doing great, I mean, great seasoned funds, you've got good, what do you call it, value in the property, down payment of at least 5%, 720 FICO score, we could still meet the 30-day or less.
All right, thank you.
Okay, you're welcome. Okay, so the FHA would go in there and they always want to see, do an ocular inspection on the condition of the home. So if you guys are listing your property and you've got an FHA buyer, you want to make sure that at least the home is addressed in terms of these conditions of repairs, like peeling paint. The appraiser is going to call on that. Unpainted downspouts, broken rain gutters, they're going to call on that. They're going to put that as a repair list of repair condition. Rotting out building, any demolition. Okay, I haven't seen this yet. Oh, sorry. Exterior doors that may not be properly closing or opening. You got to watch out for that. So do your inspection and pre-inspection at least, and it would save you a lot of grief if, you know, maybe flaking paints, it's easy for, you know, just to have that straight and, you know, just paint over. Even if you just put a primer, as long as, you know, the peeling paint is not seen. Leaking defective roofs. You know, sometimes when the inspector comes in and he sees a stain on the ceiling, that's is a clear sign of there has been a leak before, or might be still a leak that has been not addressed. So if you see that, you may want to check with your seller and make sure that that's been addressed. And if it has and there's no leak, then paint that stain over. So it's not going to be an issue by the time they come in. Pest infestation, of course, if they see, you know, infestation, evidence of infestation, and there's a rotting, you know, eaves or whatever wood around the area, that's going to get called for. And here's another list. So you got a lot of lists in the bedrooms. For FHA repairs. Bedrooms without minimized size windows, or bedrooms with bars that have no release hatch. You know, that's important. So I haven't seen that in a while. That was pretty prevalent back in the 80s, I mean, the 90s rather, and early 2000s. But most of the release, the bars have already that auto release hatch, which is good. Foundation and structural defects. If there's a really, really big crack, maybe in the garage, that may be called on. Although I've seen a garage with about a 2-inch crack, and it was about maybe 6 or 7 feet long. I was surprised the appraiser did not condition for that. Maybe, you know, who knows, it might be just, you know, he wasn't concerned about that. So that surprised me. Okay, what else? So basically that's about it. And a stove, if it's a gas stove and it's not installed in the property during the inspection, that's going to get called for. They're going to require that you have a stove that is securely fastened or installed in the gas line in the property and working, because they're going to test that. If it's an electric stove, that's fine. But if there is a gas, you know, line going in there for the stove and there's no stove, definitely that's going to be required and called on. Okay.
So as clarification, Jonathan, if you're doing an FHA loan, the kitchen has to have a stove?
Yes, it has to have the stove. Guess what? They're going to turn on the stove to make sure it's working too, and that there are no gas leaks.
Okay.
The appraiser does that. Right. And of course, you know, check the smoke detectors and carbon monoxide. You know, that's important. Okay, any questions on the repair list for FHA? Okay, moving on. VA loan. This is great. VA loan was my favorite loans. You know, I just got a VA borrower, and guess what? Rate for VA at 0 points is like 2.8. I was able to get him, he paid a point to get a 2.375 30-year fix for a VA rate. And again, VA, 0 down, minimum FICO, 580. I'm not seeing a lot of that, but if there is, we do have a source, but be prepared for 60-day escrow on that, along with the 620 score. If the credit score of the veteran is above 640 and above, then it's a much easier, it's a much faster process. The only thing about VA is the appraisal. We have to order the appraisal on the VA portal, and then a VA appraiser is assigned. And that may take some time. The last VA experience I had, he was pretty fast. He was like, it was done from the time he ordered to the time it came in was about 7 days. But for the most part, it has been my experience that from the time we order to the time we get the appraisal, it takes 10 days or a little bit more. Okay, so just be prepared for that if you're doing a VA loan. Again, BK seasoning and foreclosure seasoning is about the same as FHA. No PMIs applied to VA, even if it's 0% down. The great thing about VA, you know that VA has a funding fee of 2.25%. Let me explain what that is. For a first-time user vet, you know, if he's purchasing a property of $100,000, there is an upfront funding fee of 2.25% of that, which is financed into the purchase price, because the purchase price is actually the base loan amount, 0 down, right? So plus 2.25%, the new loan amount or total loan amount becomes $102,250. Now, if the VA is disabled, life disability because of active duty, that upfront fee is waived for the vet. All right. Also in California, I think they're crediting up to $100,000. Yeah, let's say for instance, if the properties he's purchasing is 500,000, what they'll do is they will compute the property tax based on 500,000 less 100,000, which now brings down the property tax to 1.25% times 400,000. Okay, do you get that? Did I say that clearly? All right. So if the vet is disabled for life due to active service, he does get extra credit on his property tax by the state discounting $100,000 to the sales price, and based on that, the sum, then we calculate the property tax, 1.25% times that amount. Okay, 100% of the closing costs could be paid for by the seller. Now, just because the guy's going VA doesn't mean, you know, his costs are automatically paid. There is a myth going out there, and a few of the vets that I've talked to somehow thought that they didn't have to pay closing costs, you know, on top of not having to put it down. I said, no, there are closing costs entailed. There is the escrow, title, and lender fees. Sometimes it's anywhere between $35,000 to $5,000, depending on the purchase price. And then you have another set of costs, which are the reserves. You know, at this time of the year, they're collecting 9 months of property tax and 3 months reserves. Plus, of course, you got to pay the 1-year premium for the insurance. Okay, so that's another set, you know, that's going to be added onto the loan. It's not only VA, it's all loans. If you want your payments impounded, VA and FHA, it's required that your payments are impounded. So you're going to have to bring in those reserves. All right. Now, when they say no reserves required here, this only means that at the close of escrow and he's paid his closing costs, he could have $0 in the bank. That's what we mean by no reserves required. No credit, okay, as long as one of the spouse, okay, as long as he has a spouse that has a score. Now, the only person that can help qualify for the vet on a loan like this is a spouse. Anything outside of that becomes too complicated, because if it's a fellow veteran, his eligibility may be different from the other guy. So in which case, it's not going to match. If it's not matching eligibilities that they have, then you know, they can't go through the loan together. It's one or the other. For a spouse of deceased vet, may qualify for VA loan? Yes, she may. Haven't seen that happen yet, at least not in my experience, but yeah, that's open. All right, next loan program. Let's see what we got. Okay, 2020 loan limits. 2020 loan limits, just to remind you, this is what it is. LA County and Orange County, 510, 400. You get the best rates here. So if you're on conforming loan limits, that means, you know, the rate for 15 years is going to be for a single family, 2.25 for 15 and 2.875 for 30. Now, when it comes to units, there are going to be add-ons to the pricing. So for that same rate, it may cost you. Or if you don't want to pay costs, you know, points to that rate, you may bump up the rate. You know, I'll tell you frankly, I don't know what the going rates are for the units. You know, I haven't done units on right now. It's mostly single family, but you know, it's usually maybe about 1/8 or 1/4% higher on the rate, or same rate for additional costs. Anytime you exceed 510, 400, let's say for a single family, becomes a high balance loan, up to 765, 600. Okay, for LA and Orange County. So this one here, anything that exceeds this becomes a jumbo loan. And you know what happens in the jumbo loan? You get really, really great rates with a bank if you qualify. I don't know if they're going 10% down now, but they usually needed 20% down for jumbos, especially with the big banks. And when it comes to jumbos, we're good with jumbos on special need clients, okay? But for those that could qualify, you know, with their income, great credit, and then putting, you know, at least 20% down, guess what? Can't beat the banks. They've got the better rates. So that is it. Do you have any questions right now? Nope. Good.
Yeah, Jonathan,
Yes, sir.
I know it's still relatively new, but do you have any updates on ADUs? how, if you're selling a property or buying a single-family residence that has an ADU, how is FHA looking at that, and how are appraisers looking at that?
It's a good question. I did check into that, and if my memory serves me right, it's been about over 2 months. That's when your architect was, I think, made a presentation in one of the meetings. And yeah, they will add that on to the value of the home. The ADU, that's an addition, right? Where you use a garage as a living space. Right.
So do they look at, when they add on that value, is it based on the construction, on just on a cost value, or do they look at it as an income?
They don't look at that as an income, but they will look at that as an added square footage, which adds on to the value.
Oh, okay. All right. Thank you.
Right. Sure. Okay. So last but not least, I just wanted to show you a comparison of loans for the same sales price. If you're going FHA, the same sales price of say $450, this is the cash to close with FHA. If you could qualify for the Home Possible program with a minimum of 3% down, this might be a better choice for you. Just a couple of grand more than the cash to close with FHA, and about $15 less in terms of your monthly payment. And then you got the 5% down regular program. Where is that? Sorry, this one here is wrong. This amount is wrong. But anyway, let's go to the 10% down. This is about how much. But here are the monthly savings, in cost comparison between FHA all the way to conventional. Now, I just based it on the rate of 3.125 because I'm basing on FHA. That's where the rates are going right now. On the 3% down, because it's a Home Possible, again, this is somewhere the ballpark figure of it. Now, usually the 5% down is off today. We're at about 2.99 or 2.8, but definitely 10% down, you're going to be at 2.8 for the conventional rate. So that concludes my presentation, unless there are some questions that you.
Yeah, Jonathan, we got a couple of chats. If you want to open up that box at the bottom there.
Okay, hold on 1 second. I'm sorry, I'm not too familiar.
Yeah, one was from Helen on the rates on condo purchases.
The rates on? Hold on 1 second. Let me just open this. Am I?
Yeah, I can read them for you,
Okay.
Jonathan. So Helen had a question. Are rates higher for condo purchases?
Are rates higher for condo purchases? Yes, there is a hit on condo purchases, condo attached purchases. It's a very, very minimal hit. Today's market, I would say that at least last week, it was like a hairline hit. Other times it's about 1/8 on the rate for condos. Okay.
Okay, and also from Lorraine, are any special programs for nurses or teachers as far as down payments for qualifying or for lower interest rates?
Yes, there are lower interest rates, none that I know of, but for down payment, there is the CalHFA loan, which is the California Housing Finance Administration. And they do have down payment assistance for these folks, nurses, special for teachers, and then first-time home buyers. The only thing about CalHFA is that they are quite pricing the rates. So if today's rate, let's say, is 2.8 for a 30-year fixed, you're looking probably at the mid-3s or high 3s on that type of program.
And from Shireen, this gets back to my ADU question. So if you have a garage that's converted to an ADU, that's legally converted and permitted, will that enhance the value for the appraisal, or will it be penalized since there's now no garage?
No, absolutely. I mean, ADU, you do everything through building and safety when you want to add that, because if you don't, then it doesn't count. But if everything is done above board, yes, it does add value. And
so that would actually be living space, and that would be added.
Exactly, add living space there. And
Okay.
I don't know, when you do an ADU, there are some requirements, right? It's got to have a bathroom or something.
Yeah. The city has they have restrictions, but it's mainly mandated by the state, and they have to approve it within 60 days. So yeah, I still think once we get out of this pandemic, that's going to affect a lot of properties, a lot of single-family residences.
Right. Now, there are other homes up to now that still have unpermitted living spaces in the garage. You know, some folks say, you know, I see it a lot happening in Carson, Hawthorne, Inglewood. They rent out the garage and they put a bathroom in there and a kitchen. Well, if you're going to do, when come time to sell, you know, the appraiser will require for the bathroom to be taken out and for any lines, whether it be gas lines or water lines, to be capped. If, you know, if not, that's going to be a condition before closing. It's going to, you know, have to be taken out.
Oh, thank you, Jonathan. Any other questions? I don't see any other hands raised or any other chats here. I appreciate your time today for giving us this update. If any of our agents have any other questions, I am in the office despite my background here. So give me a call, text, or email. I'll be glad to discuss everything. And happy birthday to all of you that are born in August. Make it a great day. Adios.
Thank you.
Adios.
Great meeting.
Bye-bye.
Where's